So looking ahead to this week, which begins September 30th, the big economic event of the week is non-farm payrolls. It's the first week of October, traditionally a very difficult month for the stock market, but the first Friday means it's non-farm payrolls. But it's quite possible that actually markets get preoccupied by politics, particularly US and UK politics. We had last week some fairly extreme situations. We have the proceedings beginning for the impeachment of Donald Trump in the US, and in the UK, Parliament is now back in session after the prorogation was ruled to be unlawful. So clearly the currencies, especially the dollar and the pound, will be in focus for this coming week. But next we'll just run through the main economic data points and then we'll discuss those political points in more detail. As far as the general markets backdrop, we did see the US equities pull back somewhat after that impeachment announcement, but they did rebound afterwards. We've also seen some strength in the dollar, obviously not reacting in terms of instability of the politics in the US, but more as just a source of haven flows. The British pound has dropped. That was a source of political uncertainty, and so the resumption of Parliament, that decision by the Supreme Court sending the British pound lower. The euro also lower for its part, it's back below that 110 handle. That's just an ongoing set of bearish conditions for the euro after those ECB policy moves that we've seen this month. And oil, for what it's worth, is right back and below the pre-Saudi drone strike levels. And gold, for what it's worth, seems to be holding its own, although still in the midst of somewhat of a pullback. Next, we'll get into the economic data points. The big one for the week as far as data is NFP, as I mentioned in the introduction there. Expectations are for 130k jobs created after the 162k previously. Forecasters appear to be acknowledging the jobs growth is slowing, but it's hard to see any justification for drastic interest rate cuts, more drastic than the 25 beeps we saw this month from the Fed on the basis of the labour market data. Overall, as we look at the environment, including this week's job numbers, it still looks fairly favourable for the dollar. There is also UK GDP data, which is expected to show a bump in quarterly activity after a contraction in the prior quarter. So that puts a recession off, at least in the UK, if these data points come to fruition. In part, it's because of stockpiling, because of the October 31st EU exit dates, and not altogether proof of economic strength. And the RBA will set interest rates, and there is inflation data from the Eurozone and Switzerland. Right, let's rip the plaster off and just get straight into Brexit. The effect of the Supreme decision that essentially null and voided the prorogation of Parliament meant that Parliament came back into session was a negative for the pound. I think that's pretty straightforward. That's just straightforward political uncertainty playing into the currency. So in terms of a short-term knee-jerk reaction, that makes sense. Obviously, what we're looking at now with those price moves already having taken place is to look at the more medium-term effect of Parliament being back in play. And we tend to think it is bearish for the pound. A couple of reasons for that. One, we do think there is some argument to be had that Parliament being back in session and forcing the government into limiting its negotiating abilities does just reduce the chances of getting a good deal that would actually pass through Parliament. And secondly, on that point of passing through Parliament, the other effect of all this political chaos and the distinct rivalry that's taking place essentially between Boris Johnson and Brexit leavers, and some supportive parts of the Conservative Party versus all the opposition parties and Remainers, there's a sense of animosity there means that because Boris Johnson is running a minority government, any deal he brings back, even if it's a very great one, which seems unlikely, it's just going to have cosmetic changes probably to the Irish backstop, which we've talked about many times. It's just unlikely to pass through this hostile Parliament. And so we think the fact that a deal just seems much less likely now for those two reasons is a negative for the pound for the time being, until we get to perhaps another inflection point in which perhaps a second referendum comes into viewpoint. But that's not where we are right now. Now, of course, I have to cover this other bit of political uncertainty we're dealing with, which is the impeachment or the proceedings beginning for the impeachment of Donald Trump. This all relates, of course, to this phone call that he had with the Ukrainian president, which seemed to be trying to dig dirt on a political opponent, Joe Biden, which does go against the principles of US politics, and so has been deemed baseless enough by Democrats to launch these proceedings. I think if the Mueller probe is any way to go by, then actually this impeachment is probably likely to cause some kind of short-term bumps in the road as these news announcements come out, and it's going to be an ongoing topic which is going to affect markets, but it doesn't have to pull down markets more broadly bearishly. We have the evidence in front of us that the Mueller probe, although of course we're past it now and no guilt was found on the behalf of Donald Trump, nonetheless, we could see that markets were still able to push higher. The difference, obviously, being this time around is that we don't have US tax cuts, and we do have the trade war with China. So the environment is slightly different for this kind of political uncertainty. And so I think probably the fact that the environment is different in this environment as we currently stand means that there is a bit more room for caution about what this impeachment means. We can't entirely just brush it off, and we are trying to test those record highs in the US markets. It makes a failed test and another leg lower more likely, in our opinion, this impeachment does. An important point I would put on top of that is that with regard to the overall environment, the trade war probably still is more important to where US indices especially go from here rather than these impeachment proceedings. And insofar as the trade war, we had quite an important development last week, which was that the US gave some exemptions to Apple with regard to these new tariffs on China. So if the US government is going to go down the route of protecting US companies, it's already done so for the US's biggest company, or one of its biggest at least, then it's suggested it can do so for others, particularly these big technology names, which are important leaders of the stock market. So the economic effects of the tariffs are probably going to be felt a bit later. And so if corporate profits are being propped up, firstly by tariff exemptions and secondly by lower interest rates, then actually this stock market does have room to the upside. Right, thank you very much for watching this video. Much appreciated for your viewing. If you do enjoy these and want to see more, please make sure to follow myself and LCG on YouTube and social media.